But if I tell you that the bank account you have been using for years in India becomes illegal to operate once you become an NRI. Surprisingly, thousands of NRIs continue using their resident saving account even after moving abroad. Most of them do not even know they are violating the FEMA regulations. And when the bank finally identifies their NRI status, their transactions may get restricted until they complete the required formalities. So, if you have recently moved abroad or are planning to, watch this video till the end because this one mistake can create unnecessary banking and compliance issues. Why your saving account must change. The day your residential status change to NRI under FEMA, you are not allowed to continue operating a resident saving account. Instead, you should approach your bank and convert it into an NRO account. This does not just change the account name, it changes your banking status and ensure you are complying with FEMA regulations. Now, what is an NRO account? Think of the NRO account as your Indian income account. Any income that originates in India should normally be credited here. This includes your rental income, interest from fixed deposits, interest from saving accounts, dividend from shares, sale of mutual funds and stocks, and sale proceeds from property in India. In simple word, if the money is generated in India, it generally belongs in your NRO account. Now, what is an NRE account? Now let's talk about the non-resident external account. Unlike the NRO account, this account is designed to hold your foreign earnings. For example, if you are working in US, UK, Canada, Australia, Dubai or any other country, your overseas salary can be remitted to your NRE account. The biggest advantage is interest earned on this account is tax free in India. Both the principal and interest are fully repatriable, meaning you can transfer the money abroad without any monetary limit. So, if you want to keep your foreign earnings in India while maintaining the flexibility, the NRE account is usually the preferred option. Now, what about repatriation from the NRO account? Here is an important difference. Money in an NRO account is not freely repatriable without conditions. Under the RBI regulations, you can generally remit up to $1 million per financial year, subject to the compliance requirements. For this, you will typically need three documents: a chartered accountant's certificate confirming applicable taxes have been paid, second, the prescribed tax forms and declarations, third, a declaration that the funds have come from legitimate sources. So, while repatriation is allowed, it involves additional documentation. Now, what is FCNR account? There is one more account many NRIs overlook: the foreign currency non resident deposit account. This account allows you to keep your money in designated foreign currencies instead of converting it into the Indian rupees. Why is this useful? Because it protects your money from rupee depreciation. Suppose you earn in dollars. If you transfer the money into an NRE account, it gets converted into the Indian rupees. If the rupee weakens significantly and you later transfer the money back abroad, exchange rate fluctuations could affect your returns. With an FCNR deposit, your money remains in the foreign currency itself, helping you to reduce your currency risk. Just like the NRE account, the interest earned on the eligible FCNR deposit is generally tax free in India, and the funds are fully repatriable. Remember this simple rule: Indian income should be credited to your NRO account. Foreign income which is converted into the INR should be deposited into the NRE account, and foreign income which is kept in the foreign currency should be deposited in FCNR account. Once you understand this distinction, managing your finances as an NRI becomes much easier. If you have recently become an NRI and you are still using your resident saving account, do not ignore this. Contact your bank and update your resident status as soon as possible. The process is usually straightforward, but delaying it can create the compliance issues, transaction restrictions, and unnecessary complications later. If you found this video useful, don't forget to like, subscribe, and share it with someone who has recently moved abroad. It might save them from making a costly mistake.